Hi, everybody. It's Julie Grandin with eXp Realty, and I'm here today with two of my favorite mortgage loan originators. We were talking on the phone last week in reference to a client, and they were telling me about this really great 6-month ARM product. And you don't really hear about ARMs often anymore. They used to be used several years back. So I thought it'd be fantastic to have them on the channel so that they could share some of this information with my viewers. Hi, Annika.
Hi, Julie. How are you? Thanks for having us.
Hi, Yousuf.
Hi, Julie. Thanks for having us.
You're welcome. Thanks for coming. So it's Annika Mikkelsen and Yousuf Hanif of Buckingham Mortgage. So first off, guys, I would love it if you could tell my audience what the difference is between a mortgage broker versus a typical bank.
Typical bank usually offers a very limited number of programs to their customers, whereas a mortgage broker like Buckingham, we work with 10 to 15 different investors and banks so that we can offer our clients a wide variety of programs that's best suited for their needs. So when they come to us, we're ready to pair them and make sure that it's the best possible fit for them. More options is always better. And we do all the research and all the hard work for them. So when they come to us, we know exactly where to direct them. And it's always as easy as possible for the client.
So kind of like shopping 10 banks all at once.
Yes, exactly. So we're the personal shopper when it comes to mortgage rates. And we've seen that the mortgage brokers tend to offer more competitive rates than the bigger institutional banks.
So let's talk about ARMs. So we have a fixed rate mortgage, which I think everybody's sort of been doing as a rule over the past many years.
Right.
But ARMs, have ARMs come back? What are they?
Yes, ARMs are very popular right now, especially with what's going on with the market. It provides an opportunity for borrowers and buyers to get a better rate. So basically an ARM it's an adjustable rate mortgage. And what this means is that it allows a buyer to take advantage of a mortgage rate in the first years of their loan that is normally lower than what you would see in a conventional 30-year fixed loan.
So, but with the rates having been so low over the last several years, the ARM wasn't really needed necessarily, I guess. So now we're actually seeing more of a difference.
I'll speak to that really quickly. So the rates have risen for the 30-year fix. So that has brought in the demand for the ARMs. So with the market where it is now, with the fixed rates being in the high fives and some in the sixes, the ARM brings us back to the interest rate where people have been in the last couple of years, where we can go as low as 2.5% on this specific program that you were mentioning earlier. It's an asset for the clients.
Wow. Yeah, that's amazing. And that's why I wanted to have them on, because, people have been looking at this 2.5, 2.7 sort of rate over the last couple of years. And it's kind of shocking to be at 5% all of a sudden or higher. So hearing that we could actually do 2.5% still, you just have to do an adjustable rate ARM is amazing to me. It's a reminder because I hadn't seen one in so many years. I wasn't thinking about it.
It's been a long time since we were offering ARMs because the 30-year was so strong that ARMs were out of the market. So it's been a long time. So when these started coming back around, it was great because borrowers who missed out on that for the 30-year can still get that interest rate to make sure that their monthly payment is low.
Yeah, that's great. I actually had an ARM on an investment condo of mine and it went down. So randomly,
so you were able to take advantage of that.
Exactly. So when the rates went down, a few years ago, down to 3 and then 2.5 and stuff, it went down for my condo. So that was great without having to actually, why can't I think of the word? Without having to, it's half of your business.
Without having
my rate went down without having to
refinance.
Refinance. Yeah.
Yeah, so that's the best part. Obviously, you were able to take advantage, and so we've had clients in the same exact scenario, and they gave us a call just to make sure that everything was right, because usually the adjustment goes the other way. So they were a little bit confused, but very happy.
Yeah. Okay, so tell me about the adjustable part of it. Like, so the 2.5 is good for
So for this program that we were talking about, it's 2.5 is the initial interest rate. It's locked in for that 6 months. Then at that 6 month is when the first adjustment will occur. At that point, it obviously depends on the market. It's based off of the SOFR. What will happen is it will adjust accordingly. The max it can adjust the first time is up to 2% percentage points, but we haven't been seeing that. It's about an average of 1 percentage point. And then every 6 months after that, it will adjust again. After that initial adjustment period, it can only adjust 1 percentage point higher. And then there's a lifetime cap of 5% from the original interest rate that was offered. So if we lock you in originally at 2.5%, the adjustment will be 7.5. And that's the worst it will ever get. And it's been something that a lot of borrowers have taken advantage of, and they're very happy with it.
How do they decide when and what it should adjust for?
So the adjustment period is set. It's a 6 month program. We'll adjust at 6 months, and it will be dependent on the index and margin that is part of the program. It obviously will depend on what is happening in the market at that 6 month time.
If the rates remain the same around 5.5%, you'd expect an ARM like this one, for example, but any ARM to go up sort of closer to that. But it would be only within increments. So say a specific ARM would readjust once a year and it can only go up 1 point. That would mean in a year, it would go up to 3.5, or 2 points, it would go to 4.5. But at the same time, if the market rate went down, the ARM probably would remain the same or go down depending on where it started, right?
So right now where the market is, the ARM will rise and fall just as the 30-year will. So if the 30-year goes up, even further than it is, then that ARM rate will probably go up just a little bit, but it won't go as high it won't keep pace with that rise of a 30-year. So 30-year goes up to 7%, that ARM, will go from that 2.5 to maybe 3%. So right now it's a good time to take advantage of this program.
So it wouldn't be likely to go up if the interest rate stayed at like 5.5, 6%. It would probably remain close to the 2.5, or would it?
Yeah, it would remain close to the 2.5.
Yeah.
It would adjust higher, but close to the 2.5.
Can you tell me a little bit more about why ARMs were created and how they work or make sense?
ARMs were created to allow more people to obtain a home loan. They were unable to pay the monthly payment that a higher interest rate would have them pay. So it allows people to qualify for a more expensive home. It also gives people the opportunity who are transient or who know that they're not going to be in a home for more than 2-3 years to capture a lower rate that works best in their best interest. And then they can sell, if they're going to move out of the state, if they're coming into the area because of a job, or if they know that they're going to refinance in a certain period of time, it makes sense. So if they're unable to qualify for a 30-year fixed rate, or the rates are too high for them, ARMs allow these people to come in, and buyers and borrowers to come in and take advantage so they can have an affordable monthly payment, and then also give them the opportunity to refinance when the rates are better. It also helps the economy because during periods where, the market is where it's at right now, it keeps the mortgage industry going, and it keeps people buying homes and staying in homes. And then when things level out, it allows those people to refinance without experience a payment shock.
Right. And I think that it's something just to keep in mind because it has not been in anybody's mind. I haven't heard somebody talk about an ARM for years. So it is really good to
programs like this, because lenders in every avenue of life, competition is good. So these lenders are competing with each other, and they're coming up with these really creative ARMs to help borrowers. And as much as it's helping the borrowers, it's helping everybody in the industry, because we're able to get in front of the clients and offer them these programs. It helps the real estate industry. It's helping everybody, being able to get people in homes or take advantage of the rates, even if it's a refinance situation. But these different programs allow customers, like Annika was saying, to get into homes, something they can afford, or to take advantage if they need to refinance.
So that's great. Something to be aware of. If you think you've missed the low rates, you may not. You just need to ask the right people and find a good option, because the arms are out there and they might be, the perfect solution. So you guys have probably then about 10 or so arm options, or, maybe at least a handful or so to pick from.
Oh yeah, so I could go on and on. We have 6-month ARM, 5-1, 5 and 7-1 are the most known. Just about every lender has that, but we have 5-month, 10-year with 6-month option, 5-year with 6-month option, 1 year with 1-year options, and it gets really crazy. But we can basically, with the amount of investors we have, we can really tailor each of these programs to what they need and what best suits them.
So where do you guys do business? In Virginia or elsewhere? Or
So we're licensed in DC, Maryland, and Virginia. We're headquartered in Virginia, in Vienna. So we're local, but we also are licensed in Colorado, California, North Carolina, Delaware, Florida.
And soon we will be New Jersey, Texas, and South Carolina, and New York down the road.
So to sum things up, basically an ARM is an adjustable rate mortgage. They will have certain times in which they're expected to adjust. They'll go up or down based on market conditions. And there's usually a cap, or there's always a cap, where they won't go above a certain
There's
number.
always an adjustment cap, which during those adjustment periods, it can't rise above a certain amount, depending on the program that's chosen. And then there's also a lifetime cap, which means, for instance, if it is what's called a 215 type of ARM, that means that last number 5, that is the lifetime cap, and it cannot go above 5 percentage points of the initial interest rate that you were locked in at. So you don't need to worry about that every year for 30 years, it's going to adjust 1 percentage point. I'm going to end up at 33%. If we lock you in at 2.5%, the worst that will ever happen of the lifetime of the loan will be 7.5%.
If you could feel comfortable with a higher one or refinance before that's even possible, then an ARM would be a safe bet.
Exactly. So the hope is in the next 2-3 years, when the 30-year, interest rate comes back down or lowers, maybe it's 3 years, we'll take our clients out of the ARM and take them into a 30-year fix, so that they don't have that fear of the adjustment every year, and they can be able to take advantage of the rates that people were taking advantage of over the last 2 years. So the great thing about this 6-month ARM program is that there's rates as low as 2.5%, and we accept credit scores as low as 660.
So how should viewers learn more about this option?
They can learn more about this by contacting us at Buckingham Mortgage. My contact information is Annika, ANNIKA, at bfgusa.com, or they can reach out to Yousuf at bfgusa.com, and that's YOUSUF.
That's great. And I'll have all of that information and some other great info in the description below, as well as a link to a blog, which Annika guest authored for my website. So I'll have a link to that, and that goes into the ARM in a little more detail, and it'll work kind of like a recap for this as well. So Yousuf, Annika, thank you so much for joining me today. So much great info.
Thank you, Julie. Have a great day.
Thank you, Julie. It was a pleasure.